Did you know that the stock market has averaged around 10% returns annually over the last century? But here's the kicker. Most people don't know how to take full advantage of it. Are you missing out on building serious wealth through stocks? If you've ever felt confused about where to start or overwhelmed by all the terms and strategies, don't worry, you're not alone. I'm here to break it down step by step so you can make confident decisions that grow your money over time. Whether you're just starting or looking to refine your approach, this video will help you understand stock investing and get you on the right path. Many beginners think investing in stocks is risky, and they fear losing money. It's true there are risks involved, but the reality is that stocks have historically been one of the best ways to build wealth over the long term. The problem is, most people don't understand how to minimize those risks or how to pick stocks that actually have the potential to grow. They also don't realize that not investing in stocks means losing out on compounding returns that can work wonders for your financial future. So, how do you get started with stock investing? Let's break it down. There are different kinds of stocks you can invest in. One of them is common stocks. Common stocks will give you ownership in a company and voting rights at shareholder meetings. They also allow you to benefit from the company's profits through dividends or stock price appreciation. Another type of stocks called preferred stocks. These stocks typically pay a fixed dividend, but don't come with voting rights. They're considered a safer bet compared to common stocks, but usually offer less growth potential. Step 3. One of the most important steps in stock investing is developing a long-term and right mindset. The stock market can be volatile in the short term, but history has shown that over long periods, it tends to go up. This is where the magic of compounding comes into play. When you reinvest your earnings, whether they're dividends or capital gains, your money starts to grow exponentially. The longer you stay in the market, the more powerful compounding becomes. If you invest $10,000 and let it grow at 10% annually without withdrawing any earnings, after 20 years, your investment would grow to about $67,275. After 30 years, it would balloon to over $174,000. This exponential growth happens because you're not just earning on your original investment, you're earning on the gains you've already made. The longer you stay in the market, the more compounding multiplies your returns, making it one of the most powerful forces in wealth building. Step 4. Build a diversified portfolio. Diversifying your portfolio helps reduce risk and balance returns. Studies show that holding 30 to 40 stocks across sectors can lower volatility by up to 80%. A 60 by 40 portfolio of stocks and bonds had 50% less volatility than an all-stock portfolio, providing more stability during downturns. Global diversification also cushions against underperforming domestic markets, while real estate offers strong returns with low stock market correlation. Overall, diversification smooths returns and protects against large losses. Step 5. Learn how to analyze stocks. Analyzing stocks might sound complicated, but it's a crucial part of making smart investments. There are two main approaches. Fundamental analysis. This is like looking under the hood of a company. You'll want to check out its financial health, things like revenue, profit margins, and how fast it's growing. You also assess how strong the company is in its market and whether it has a solid leadership team guiding it. Technical analysis. This one is all about the stock's price movement. Instead of focusing on the company itself, you're looking at charts and trends to predict where the price might go in the short and long term. Both methods can give you valuable insights, so learning them will help you make better stock picks. Step 6. Choose between individual stocks and ETFs. If you're just starting out and aren't sure about picking individual stocks, ETFs can be a great option. ETFs, or exchange-traded funds, are like baskets of different stocks. So when you buy one ETF, you're actually investing in multiple companies at once. For example, an ETF that tracks the S&P 500 includes the 500 largest U.S. companies, giving you instant diversification. This means if one stock in the ETF doesn't perform well, others might balance it out, reducing your overall risk. For beginners, ETFs can be a lower risk option compared to buying individual stocks, where you're betting on just one company. Plus, they require less time and expertise since professionals manage them for you. You don't need a lot of money to begin investing in stocks. Thanks to apps and commission-free platforms, you can start with just $100 or even less. The key is to build a habit of investing regularly. This means putting in a fixed amount of money over time, whether the market is up or down. This approach is called dollar cost averaging. Here's how it works. By investing the same amount regularly, you'll automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this can help reduce the risk of timing the market's ups and downs and smooth out the impacts of market volatility. Consistency is your best friend when it comes to growing your investment portfolio. Step 8. Watch out for fees. Fees may seem small, but over time, they can seriously eat into your investment returns. There are a few types of fees to keep an eye on. Trading fees. Some platforms charge you each time you buy or sell a stock. These can add up, especially if you trade frequently. Management fees. If you're investing in mutual funds or ETFs, these funds often have management fees, also called expense ratios. While they might seem small, like 0.5% or 1%, they can compound over time and reduce your profits. Taxes. You may also have to pay taxes on your investment income, such as dividends or capital gains when you sell a stock for a profit. By minimizing these fees, you can keep more of your hard-earned money and see better long-term growth in your portfolio. Now, here's the most important part of stock investing: patience and discipline. The stock market is full of ups and downs, and it can be tempting to react to every piece of news or short-term dip, but that's where many people make mistakes. Successful investing isn't about getting rich overnight. It's about staying committed to your long-term goals, even when things get tough. The stock market tends to grow over time, but in the short term, there will always be volatility. Patience means not panicking when the market drops or jumping on trends without careful thought. Discipline means sticking to your investment strategy, whether it's regular investing, dollar cost averaging, or a diversified portfolio. Even the best investors face losses, but the key is to manage those losses wisely and stay focused on the bigger picture. Over time, by holding on to your investments and sticking to your strategy, you'll be in a much better position to grow your portfolio and achieve your financial goals. So begin your stock investment journey and watch your wealth grow exponentially through the power of compounding. Now I'd love to hear from you. Are you already investing in stocks, or are you just getting started? Drop a comment below with your experiences or questions. And if you want to learn more about building a diversified portfolio, be sure to check out my next video where I dive into creating an all-weather investment strategy. Don't forget to like and subscribe for more tips on how to grow your wealth. I will see you next time.